But Pankaj Tibrewal joins us on the show right now to talk about what he's making of the market right now. Pankaj, hi, morning. What are you making of the market construct? For the last 8 days, FIIs have been buyers, and that's clearly reflective in the way some of the banks and the IT names too have been performing.
Yeah, good morning. Our view is that in this raging bull market, the reliance on narratives and myths are increasing rather than focusing on fundamentals and valuations and numbers. I think what we are seeing over a period of time is that there are pockets with frothy valuation. And when we look at from a bottom-up perspective, there are very few sectors which offer margin of safety as we speak. And there are many sectors where investors are ignoring the basics of investing, which is balance sheet and cash flows. So we believe that we need to navigate the next 12 to 18 months with caution. And today, we should be a risk manager instead of a fund manager. And managing risk in the portfolio will be extremely important because the earnings growth has started to slow down in our view. Last year, we saw that NSE 500 companies delivered 30% earnings growth. But as you move into FY25, our view is that earnings growth should come down to between 13 to 15% for the NSE 500 universe as a whole. And that's a substantial de-escalation as margin tailwinds, which were a big supporter of earnings growth in FY24, should start to recede. And on the banking side, the credit costs are at its best levels. So we believe that earnings growth should be more in the 13 to 15% zone for the NSE 500 companies. And market should track the earnings growth, assuming the valuations remain where it is, and there's no derating or re-rating on that. So I think in the first 6 to 8 months, in the first 6 months, we have seen that markets being one of the best performings globally. But if earnings starts to de-escalate, I think there should be some pullback, which we should see in the markets as you move ahead.
Pankaj, good to see you. I gather that IKIGAI Asset Management has started deploying the funds raised. You've already raised a shade lower than 2,000 crore. Have you found your purpose in life? Have you found the fulfillment? Are you finding it very fulfilling, running your own fund, looking for idea? Yes, it's a tough market. The low-hanging fruit may have been gone, but this is what you specialize at, right? Looking at areas which nobody else is looking at and deploying.
Very well put, Ajay. I think IKIGAI stands for purpose of life. And the reason we started this fund is that we all, throughout over the last 2 decades, what we have understood is compounding. And that's what we want to do for our investors in the right way. And there are 3 core principles where we don't want to dilute, which is trust, performance, and process. I think these 3 are the core pillars for IKIGAI, and we want to continue. On the investing side, yes, we have started to deploy our capital and trying to look out for areas where there's margin of safety. And that lies in pockets like auto ancillaries. And many of the auto ancillary, Ajay, are moving from typical pure auto exposure to non-auto exposure, basically the aerospace, the defense, and other things. And I believe there is a significant scope of re-rating if they continue to execute in the right way over a period of time. And the reliance on auto will come down over a period of time. So we have increased our exposure to some of those names out there. The second is the financial space. I think last 2 years, you saw massive divergence between PSU and private. I think that we have started to see the gap bridging now. And our bias remains towards private sector, both lenders and non-lenders in this space. The third is the pharma. I think we are positive on the US generic space, at least for FY25. And we believe that pharma offers a decent margin of safety as we speak. And the fourth sector probably is the consumer, staples and discretionary. Our early channel checks suggest that there is a pickup, both on the rural as well as on the urban side on discretionary. June continues to be a decent month after many months, both on the SSG for many retailers, as well as the rural pickup is being strong. So we believe that if you look at the portfolio from more of a diversification perspective, I think there are still pockets which offer reasonable valuations and probably visibility of earnings growth in FY25 and FY26.
Pankaj, very interesting answer. You've actually given a lot of meat to us. Where exactly are you starting to deploy? But one particular, so it is very interesting to also start tracking, where IKIGAI is sniffing for ideas and your activity. And we saw one of your recent names in one of your in the block deals. But I want to talk about this area of ABS. Basically, the material which goes into all kinds of electronic manufacturing. When we speak to Dixon or Amber or many others, one gets a sense that this category is set for high growth. Very few large, reliable players exist in the system on the listed space. I mean, but in the listed space, only one material providing company exists. Can you talk to us a little more, whatever you can, in the ambit of regulation about this ABS as an opportunity, and how does it look from here on?
So, Ajay, without going into specific, company-specific names, just a sectoral overview that the space is a pure derivative of what happens in auto and white goods, because ABS goes into both these, as a raw material. And the outlook for both over the next many years is very strong. And hence, the demand for ABS and polystyrene will continue to be strong. What has happened over the last decade is that most of the players, and especially led by a few MNCs, didn't expand as their focus was not there. And hence, import took a very large portion of Indian demand. As we speak about 125,000 ton, 1 lakh to 1.25 lakh ton gets imported from different parts of the world. And I think there's a reasonable opportunity for any player to substitute that import. And over a period of time, if we produce high quality ABS, there could be an export opportunity also. So I think there are low-hanging fruits for the Indian manufacturers that if they conduct themselves well, it can be a great opportunity. Don't forget, it's a commodity finally at the end of the day. The gross margins in this business ranges from 25 to 28, 29%, and you need to work on cost efficiency a lot. But the asset turns seem to be good. The capital efficiency in this business continues to be very strong. So there is room for many players in this industry, and it's a sunrise industry, if you ask me, over a period of time. So that's broadly our thought on the ABS without going into any company specific.
Pankaj, what is the outlook on the sector that really fired up and was at one point the darling, the entire defense basket? For instance, yesterday we did see quite a bit of fervor building up into these names. And are you looking at this space for the long haul as well?
Yes, we were positive on defense, but now I think stocks are pricing in much more than what is expected. I think next few years order inflow and earnings growth are already built into the stock prices. And don't forget that many of these stocks don't have a large free float. So the prices and the market cap which we are seeing may not be the actual ones, which probably should be through the price discovery mechanism. And we believe that there's a lot of froth in this space building up on expectations that this kind of order inflow and growth will continue for long period of time. So we need to be a little careful. The second point which I want to make is that many of the businesses in this space don't generate very great operating cash flow. And today the narrative is that just follow the order inflow and the profit numbers. But finally, we know that over longer periods of time, cash flow is the main driver for stock prices along with growth. And growth without cash flow is a recipe for disaster. And we believe that in many companies, when we look at the cash flow from operations over the last 4 or 5 years, they don't justify the market caps which the companies are trading at today. Many companies we see are trading at 30, 40, 50,000 crore market cap, but they don't make more than 200, 300 crores of operating cash. So I think we need to, don't ignore the basics of investing at this stage. where narratives and myths are taking over. I think finally, over longer periods of time, basics of investing will help you navigate any challenges in the market. So yes, longer term we are positive, but we will wait for better, entry points. And from a bottom up perspective, many of the stock are in the frothy, expensive zone.
Right. Pankaj, soon we're going to be hitting earnings as well, right? So classify for us where do you actually see a pool of profits to decelerate? Where do you think there is going to be some stability or flattish move? And where is it, do you think profits are going to be strong? If you can just, make clusters for us.
So I think, as I said, for the universe as a whole, you should expect moderate profit growth this year in FY25. And if you break down into sectors, I think the first sector where profits are likely to de-escalate in the first quarter is probably cement, PSU banks, where the best of the credit cost is in the base and NIMs will be under pressure, and deposit growth is not keeping pace with the loan growth. And obviously, paint sector, where profits could de-escalate further. These areas where it will be more status quo could be IT and consumer pack. And areas where profits could be accelerate could be capital goods and infra, because the order booking has been strong over the last 18 months, and those orders are finally getting to execution mode. But in the third bucket where profits are likely to escalate, valuations are already pricing in a lot of that growth, because most of the capital good names are trading between 60 to 100 times on the 1 year forward basis. So clearly those are in the expensive zone. And these are the three buckets where we should look at. Metals, any which ways, pricing is under pressure. So that is also likely to de-escalate quarter on quarter and year on year. So I think broadly speaking, consumer is one sector where one can see better escalation in both staples and discretionary a bit. And to my extent, infra and cap goods, where profits could further escalate from where we were last year.
Theme, the area which is not looking good right now, last few quarters have been weak. Are you analyzing something there in the consumption basket, anything where a rebound can happen?
So Ajay, I think the bottom of the pyramid, which has got impacted massively over the last 3-4 years, I think that should see a rebound. And our broader thesis remains that the rural expenditure has been flat at almost 4 lakh crores for last 4 years. And looking at the state elections ahead and the verdict which came in the center elections, I think there will be an inclination towards some kind of redistribution of budget expenditure towards the rural side. And hence we believe few staple companies, few discretionary companies, which cater to the bottom of the pyramid, can do well. A couple of retailers did their update in the last few days, and we saw very strong SSG growth, despite the fact that there is no wedding season in the first quarter, and the SSG growth was in double digit. I think that could be a leading indication that probably the value retailers and the other formats which cater to the bottom of the pyramid can make a comeback. And I think that space has been ignored for a long period of time because lack of growth. I think that could be an interesting opportunity. Some of the staple companies have started giving positive commentary from where they were for the last 5-6 quarters. And I think that's another space. And durables, I think, continue to be in a sweet spot. And our preference lies there because we believe that the profit pool of the industry is at a decadal low, led by huge competition. And incrementally, no new players want to come in at such low profitability levels. And probably with demand coming in, we should see a revival in profitability, and the summers have been extremely strong. So if there is strong summer, it leads to destocking at the dealer and distributor level. And post second quarter, the festive season starts, and the primary sales then continue to be strong. So we believe durables, some of the value retailers, some of the names on the staple side would be a good way to create a basket to see the revival in consumption over the next 12 to 18 months.
Appreciate your time, Pankaj. Good to get in your thoughts on the markets and where it is that you're seeing opportunity at the present. That's the word coming in from Pankaj Tibrewal, talking a little bit about how there is a sense of strong rural recovery and margin of safety when it comes to auto ancillaries. Pharma also is looking like an interesting space.
If you like this video, then like, share and subscribe to ET Now.